All right, let's get right into it. Today, we are unpacking an absolutely fascinating situation unfolding with one of the most recognizable names in software. We're talking about Adobe. Now, if you follow the creative or tech industries, you already know Adobe. They're the giant behind heavyweights like Photoshop, Premiere Pro, and Acrobat. But right now, as of August 2026, they are sitting at the absolute center of a massive financial mystery. We're looking at a company that is essentially crushing its earnings. They are posting record numbers left and right, and yet the stock has somehow lost a huge chunk of its value. So here's the $109 billion question we're tackling in today's Explainer. How exactly does a tech giant break revenue records and still manage to lose roughly a quarter of its value from its recent highs? It's a genuine paradox, right? Like, is this a company in crisis, or are we looking at one of the most misunderstood contrarian tech bets of 2026? Well, let's follow the data and find out.
Let's kick things off with the good news, because honestly, on paper, Adobe's financials are scorching hot right now. Just listen to this number, $6.62 billion. That is their record revenue for the second quarter of fiscal 2026. That represents a 13% jump year over year. And it really doesn't stop there. Customer Group subscription revenue hit $6.39 billion, which is up 14%. Their business professionals and consumer segment grew by 16%, and the creative and marketing professional segment grew by 13%. Management was so confident they even raised their full-year guidance to between $26.5 and $26.6 billion. So revenue is growing, guidance is up, the underlying engine is clearly humming.
But then you check out the stock performance, and it is a completely different story. Down 26%. Despite all those massive revenue beats we just talked about, Adobe's stock was recently trading at $273.92, which is roughly 26% below its 52-week high of $370.86. Actually, if we look at the year-to-date performance, it's down about 21%. And that's after having touched a deeply concerning low of $190.12 back in June before seeing some recovery. The disconnect here is honestly wild when you dig into the underlying metrics. We already covered the $6.62 billion in revenue. But underneath that, non-GAAP earnings per share came in at $5.96. That's an 18% year-over-year growth that actually beat analyst estimates by over 2%. And their total annualized recurring revenue, or ARR, exited the quarter at a massive $27.1 billion, which, to be fair, does include about $480 million from their SEMrush acquisition. Oh, and they also generated $2.17 billion in operating cash flow in just one single quarter. By pretty much all traditional metrics, these fundamentals are incredibly healthy. So why this severe penalty from the market? Section 1, the AI freemium gamble, sacrificing today's cash for tomorrow's loyalty. To solve this mystery, we really need to look at how Adobe is navigating the artificial intelligence revolution, because they are making a massive, aggressive, and incredibly costly shift in their core strategy. Just look at the absolute explosion in their AI-first annualized recurring revenue. It has literally more than tripled year over year, and it's now surpassing $500 million. Their generative AI tool, Firefly, it has already generated over 16 billion creative outputs and is setting adoption records across the board. The Acrobat AI Assistant alone saw its ARR grow approximately threefold year over year. The demand for Adobe's AI is absolutely there, and it's growing at an exponential rate. But growth like that doesn't come for free, which brings us to a really pivotal quote from CEO Shantanu Narayan. He recently stated, "We believe now is the time to aggressively acquire the next generation of Adobe loyalists." Now, what does that actually mean in practice? It means Adobe is leaning hard into a freemium model. They're deliberately giving away incredibly powerful AI-featured tools for free in order to attract massive numbers of new monthly active users. And here is the absolutely crucial trade-off. To fuel this massive freemium pivot, Adobe is intentionally taking a short-term hit. They fully expect the strategy to slow short-term ARR growth, effectively costing the company around $500 million in organic ARR. They even decided to delay planned price optimizations for Creative Cloud. They are deliberately sacrificing $500 million in short-term revenue and squeezing their near-term margins just to build a massive, fiercely loyal user base for the future. The market, which as we all know focuses heavily on short-term gains, is clearly getting spooked by this strategy of delayed gratification. Which brings us to Section 2, a sudden leadership vacuum, uncertainty at the top. Because a freemium gamble isn't the only thing making investors nervous right now, let's look at a completely different yet equally impactful factor. Let's walk through this timeline because it highlights a situation that is incredibly rare for a company of this magnitude. In March 2026, CEO Shantanu Narayan, who, by the way, has led the company brilliantly for 18 years, announced he would step down once a successor is found, though he will stay on as board chair. Then, just a few months later in June, CFO Dan Dern departed the company, leaving a 20-year veteran, Steve Day, to step in as interim CFO. Think about that for a second. Right now, a $109 billion tech giant is simultaneously searching for both a permanent CEO and a permanent CFO. That's kind of like trying to find two matching socks in the dark while your house is actively being remodeled. When the CFO departure was announced alongside those record Q2 results we talked about, the stock actually fell over 6% in after-hours trading. The good news was just completely overshadowed by the cloud of leadership uncertainty. Section 3, Follow the Money. Wall Street is divided. So we've got record revenues clashing with a massive AI freemium gamble and empty corner offices. How are the experts reacting to all this? Well, when S&P Global polled 40 analysts, it became incredibly clear that the street is deeply conflicted. A massive 57.5% majority are sitting firmly on the fence with a hold rating. You've got 30% in the buy or strong buy camp and 12.5% in the sell or strong sell camp. The consensus 12-month price target averages out to about $270.61, but the sheer size of that hold group tells you that practically nobody quite knows how to price in the AI disruption versus the record revenue. And that divide gets even more extreme when you zoom in on specific institutional ratings. On the bullish side, you have 24/7 Wall Street setting a target of $309.57, implying a 12% upside, closely followed by HSBC at $308. But then you contrast that with the bears. Morgan Stanley issued a sell rating at $240, and Bank of America went even lower with a sell rating and a $220 target. Wall Street is completely fractured on whether the AI freemium pivot will actually pay off or whether AI will just end up commoditizing Adobe's core business. But just when you think this whole story is being driven entirely by fear and uncertainty, we get a massive plot twist. $8.4 billion. On August 19, 2026, BlackRock, the world's largest asset manager, made a monumental move. They increased their stake in Adobe to more than 10%, which represents an $8.4 billion investment. That news was so significant, it literally sent shares up 4.5% in a single afternoon. And that leads us to some really vital context. While retail investors and some analysts might be hitting the panic button over slowing organic growth and empty executive chairs, the biggest whales in the ocean, they are holding strong. Approximately 82% of all Adobe shares are now held by institutional investors. Listen, an $8.4 billion check from BlackRock isn't written casually. It's a massive signal of institutional confidence. It suggests that the most sophisticated money managers look at Adobe's creative software franchise and see immense long-term value that far outweighs the short-term fears of generative AI disruption. Section 4. The Final Verdict. Weighing Risks versus Opportunities. As we near the end of our explainer today, we need to synthesize all these clues. How do we objectively weigh the existential threats against what could frankly be a historic buying opportunity? Let's try to bring this entire paradox into focus. On one side, you have very real risks. Generative AI could autonomously generate design work, which would shrink the professional market. Organic growth is slowing to around 10%. And remember, that includes the SEMrush acquisition. You've got a dual CEO and CFO search causing huge uncertainty. And the freemium strategy is absolutely squeezing their near-term margins. But on the other side, the opportunities are massive. Adobe is trading at roughly 10 to 15 times forward earnings. You compare that to peers like Autodesk at 19 times or Salesforce at 23 times, and Adobe looks dirt cheap. You have explosive AI momentum surpassing $500 million in ARR. They generated $2.17 billion in cash flow just last quarter and used it to quietly buy back 8.5 million shares, which is about 2% of the entire company. And, of course, you have BlackRock backing them with over $8 billion. Let's do a quick recap of the core contradiction we've uncovered today. We have a legacy tech giant posting record Q2 revenue of $6.62 billion, with AI revenue tripling to over $500 million. Yet, their intentional freemium strategy is hurting short-term margins. They are effectively headless while searching for a new CEO and CFO. And despite all that turbulence, the world's biggest asset manager just took a greater than 10% stake.
The competing forces driving the stock right now are truly unlike anything else in the market.
Which leaves us with one final major question for you to ponder. Value opportunity or value trap? Is Adobe intentionally sacrificing today to dominate tomorrow, making this a rare chance to buy a giant at a major discount? Or is the AI revolution a genuine existential threat that no freemium model can fix? The data is all on the table. And now, it's up to you to decide how the future unfolds for this creative powerhouse. Thanks so much for joining me on this explainer, and keep learning.